This is the satisfier they tried to bury. For 93 years, Warren Buffett has been the closest thing America has to a financial prophet. He survived the crash of 1987. He called the dot-com bubble. He loaded the truck during the 2008 financial crisis while every other billionaire was hiding under the desk. He has been wrong so rarely that when he speaks, $40 trillion in global capital repositions overnight. But this morning, Thursday, February 26, 2026, at approximately 9:47 a.m. Eastern, the Oracle of Omaha did something that has never happened in the 93 years of his life. He dumped United States Treasury bonds, not trimmed, not rebalanced, dumped. According to an emergency amended 13F filing with the SEC, Berkshire Hathaway liquidated approximately $284 billion in short-term U.S. Treasury holdings over a 72-hour window beginning Monday. For the first time in history, the man who once said Treasury bills are the safest investment there is has decided they are not safe enough. Wall Street is in free fall. The Dow futures cratered 1,100 points within minutes of the filing hitting the wire. The 10-year Treasury yield spiked to 5.14%, the highest since July 2007. The dollar index plunged below 96, and buried inside the filing, in the manager's note section that almost nobody reads, were 4 words that have sent shockwaves through every trading floor, every central bank, and every pension fund on the planet. 4 words from Warren Buffett. The covenant is broken. We are talking about the largest single divestiture of U.S. government debt by a private entity in American history. We are talking about a man who held nearly 5% of the entire T-bill market walking away from the table. We are talking about the foundational assumption of the global financial system that American sovereign debt is risk-free, being publicly rejected by the most respected investor alive. In this special report, we are going to break down exactly what Buffett sold and when. We are going to explain the forward warning and what covenant he believes is broken. We are going to trace the chain reaction that is already cascading through the bond market, the banking system, and your retirement account. And we are going to answer the question that every financial advisor in America is dodging right now. Is it still safe to own U.S. government debt? Buckle up. The oracle has spoken, and the prophecy is catastrophic. To understand why Buffett moved this week, you have to understand the fortress he spent 3 years building. Starting in late 2022, Berkshire Hathaway became the most aggressive buyer of short-term U.S. Treasury bills in the private sector. By the end of the first quarter of 2025, Berkshire held $300.87 billion in T-bills, approximately 4.89% of the entire $6.15 trillion market. That is more than the Federal Reserve itself held, more than Japan's central bank, more than every hedge fund in Greenwich combined. Buffett was not speculating. He was building a bunker. He was selling Apple, selling Bank of America, selling Amazon, and converting everything into the one asset he trusted above all others, the full faith and credit of the United States government. Here is what you need to understand about why that matters. Treasury bills are not just investments. They are the collateral of the global financial system. Every repo transaction, every derivatives contract, every margin call on every trading desk in the world ultimately references the U.S. Treasury curve. When Buffett bought $300 billion in T-bills, he was not just parking cash. He was making a statement. I trust America. When he sold $284 billion in 72 hours, he made the opposite statement, and the market heard it like a gunshot in a cathedral. Sources inside Berkshire Hathaway, speaking on condition of anonymity, say the decision was made over the weekend of February 21st and 22nd. According to leaked internal communications obtained by the Wall Street Journal, Buffett convened an emergency call with Greg Abel, the new CEO, and Ajit Jain, the insurance chief, at 6 a.m. Saturday morning. The call lasted 4 hours. By Sunday evening, the liquidation order was drafted. By Monday morning, before the bond market opened, Berkshire's prime brokers at Goldman Sachs and J.P. Morgan had begun unwinding the positions. The scale was staggering. Sources say Berkshire moved $94 billion on Monday alone, $108 billion on Tuesday, and the remaining $82 billion by Wednesday close. The operation required coordination with the Federal Reserve's trading desk to prevent a disorderly market collapse. The New York Fed reportedly opened an emergency liquidity window specifically to absorb the Berkshire selling pressure. That is how large this was. The central bank had to intervene to prevent the world's safest asset from imploding because one man decided to sell. But here's the catch. Why now? What changed between Friday, February 20th, when Berkshire still held the bonds, and Saturday morning when Buffett ordered the fire sale? The answer, according to sources close to the situation, lies in three simultaneous events that converged into what one senior Treasury official called a perfect storm of sovereign risk. Event 1. The Congressional Budget Office released its updated fiscal projection late Friday afternoon, the classic Washington document dump designed to bury bad news. The numbers were apocalyptic. The federal deficit for fiscal year 2026 is now projected at $2.8 trillion. Total national debt has crossed $38.4 trillion. Annual interest payments on that debt have hit $1.14 trillion, surpassing defense spending for the first time in American history. The United States government is now spending more money servicing its past borrowing than it spends on the entire military. Event 2. The Supreme Court's decision earlier this month to strike down the global tariff regime. The tariffs had been projected to generate $600 billion to $900 billion in revenue over the next decade. With that revenue gone, the deficit trajectory has steepened dramatically. The CBO models show debt to GDP hitting 156% by 2034. Former Treasury Secretary Janet Yellen warned last month that the preconditions for fiscal dominance are clearly strengthening, meaning the point where the Federal Reserve would be forced to buy government debt not because of monetary policy, but simply because no one else will. Event 3. The Japanese bond market crisis. On January 20th, Japan's 40-year government bond yield hit a record high. The 10-year JGB yield surged to 2.38%, the highest since 1999. Japanese investors hold $1.2 trillion in U.S. Treasuries, making them the single largest foreign holder. As Japanese domestic yields rise, the financial incentive for Japanese institutions to buy American debt evaporates. Sources at the Bank of Japan say major insurers and pension funds have already begun repatriating capital. One senior Japanese banking official told the Financial Times, "Why would we lend to America at 5% when we can lend to Tokyo at 3% with no currency risk?" That is the question that keeps the U.S. Treasury Department awake at night, and it is the question that apparently kept Warren Buffett awake last weekend. Let us get technical about what the covenant is broken actually means, because those four words are doing more damage than any financial instrument. In bond market terminology, a covenant is a binding promise between a borrower and a lender. When you buy a Treasury bond, the covenant is implicit. The United States will manage its finances responsibly, maintain the purchasing power of the dollar, and honor its obligations. Buffett is not saying the U.S. will default. He is saying something potentially worse. He is saying the implicit contract between the American government and its creditors has been violated. The government is borrowing at a pace that is mathematically unsustainable. It is spending $1.14 trillion a year just on interest. It has lost its largest revenue tool, the tariffs, to a Supreme Court ruling. And it is now competing for global capital against rising Japanese yields, European defense spending bonds, and a gold market that has surged past $3,200 an ounce. Here is what nobody is talking about. When Buffett sold $284 billion in treasuries, that money did not vanish. It went somewhere. According to the amended 13F and sources familiar with the transactions, approximately $120 billion was converted to physical gold and gold-backed ETFs. Another $80 billion was moved into Swiss franc-denominated sovereign bonds. $50 billion went into short-term corporate paper from companies like Johnson & Johnson, Microsoft, and Exxon, companies whose balance sheets Buffett apparently now trusts more than the United States government. And the remaining $34 billion was left in cash, sitting in non-US dollar accounts at foreign banks. Read that again. Warren Buffett, the most patriotic investor in American history, the man who said he would never bet against America, has moved $80 billion into Swiss government debt and $120 billion into gold. He is not hedging. He is evacuating. The chain reaction is already underway. Within hours of the filing becoming public Thursday morning, the bond market experienced what traders are calling a flash rout. The 10-year Treasury yield spiked 38 basis points in a single session. The 30-year yield blew past 5.2%, approaching the 5% level that Goldman Sachs has identified as the point of no return for the U.S. housing market. At 5.5% on the 30-year, the average mortgage rate would hit 8.3%. Housing affordability, already at its worst level since 1984, would collapse entirely. Existing home sales would freeze. The $45 trillion residential real estate market would begin repricing downward, dragging every homeowner's net worth with it. This is not hypothetical. This is math. and it is playing out in real time. But it gets worse. The Buffett sale has triggered what bond traders call a convexity event. Here is how it works. Pension funds, insurance companies, and mortgage-backed securities portfolios all have duration targets. When yields spike suddenly, the duration of their portfolios shortens. To maintain their targets, they are forced to buy more long-dated bonds. But in a panic, there are no sellers at reasonable prices. So they have to sell other assets, typically equities, to raise cash to buy bonds at elevated yields. This creates a doom loop. Bond yields rise, stocks fall, pension funds sell stocks to buy bonds, stock selling accelerates, margin calls hit hedge funds sell bonds to raise cash, bond yields rise further. We saw a version of this in March 2020 during the COVID dash for cash. We saw it in the UK gilt crisis of 2022 when the Bank of England had to intervene to prevent pension fund insolvency. But those were contained events. This is Warren Buffett, the largest private holder of Treasury bills on the planet, dumping everything at once. The containment infrastructure does not exist for a shock of this magnitude. Sources inside the Federal Reserve describe the mood as controlled panic. According to two officials with direct knowledge of the discussions, an emergency meeting of the Federal Open Market Committee was convened Thursday afternoon, 3 weeks ahead of the scheduled March meeting. The topic: whether the Fed needs to restart quantitative easing, buying treasuries with printed money, to stabilize the bond market. The irony is suffocating. The Federal Reserve may be forced to print hundreds of billions of dollars to buy the bonds that Warren Buffett just sold because he no longer trusts the government's ability to manage its debt. This is the fiscal dominance scenario that Janet Yellen warned about. The central bank becomes the buyer of last resort, not because of recession, not because of deflation, but because the free market has lost confidence in the sovereign borrower. Let us push the scenario to the extreme. What happens if the 10-year yield crosses 5.5% and stays there? First, the housing market freezes. Mortgage applications, already down 40% from 2021 peaks, would collapse another 30%. Home prices in overheated markets like Austin, Phoenix, and Boise would drop 15 to 25%. Second, corporate debt refinancing becomes a crisis. There is approximately $1.8 trillion in corporate bonds maturing in 2026 and 2027. At current yields, refinancing costs would increase by $200 billion to $300 billion annually. Companies that were barely investment grade, the BBB tranche that represents 50% of the investment grade market, would face downgrades. Downgrades trigger forced selling by pension funds and insurance companies that are mandated to hold only investment grade paper. This is the cliff edge. Third, the federal budget itself implodes. Every 100 basis point increase in the average cost of government borrowing adds approximately $380 billion in annual interest expense. If yields stay at 5.5%, the annual interest bill would approach $1.5 trillion by 2028, consuming nearly 30% of all federal revenue. Social Security, Medicare, and Defense would be competing for the remaining 70 cents of every tax dollar. This is not a debt crisis in some abstract future. This is a debt spiral that compounds quarterly. How does this play in the heartland? For the MAGA base, this is complicated. Buffett has traditionally been viewed with suspicion by conservatives. He supported Obama. He advocated for higher taxes on the wealthy. He is not one of them. But his action validates their deepest fear, that the federal government is fiscally reckless and that the elites have been lying about the safety of government bonds. When your financial advisor told you to put 40% of your retirement in bonds because they are safe, Warren Buffett just told you that was a lie. The 60-40 portfolio, the bedrock of retirement planning for 50 years, is being publicly repudiated by the greatest investor who ever lived. For independents and moderates, this is a gut punch. These are the voters who check their 401k every quarter. These are the voters who trusted the system. If Buffett does not trust U.S. government debt, why should they trust anything? The psychological damage extends far beyond the financial. It corrodes the foundational belief that America is a safe place to invest, to save, to build a life. What does China think when it sees this? What does the Saudi Sovereign Wealth Fund think? They see the most credible private investor in American history moving $80 billion into Swiss francs and $120 billion into gold. They see a man who has more information about the American economy than any living person choosing to leave. Foreign central banks hold approximately $7.6 trillion in U.S. Treasury securities. If even 10% of that begins to shift in the direction Buffett is moving, you are looking at a $760 billion sell wave that would make today's rout look like a ripple. The dollar's status as the world's reserve currency is not guaranteed by divine right. It is maintained by confidence, and confidence is a fragile psychological phenomenon that can evaporate in a single news cycle. Buffett did not just sell bonds, he sold confidence. The White House response has been predictably defensive. Sources inside the West Wing say the president is furious and has reportedly called Buffett a senile trader on a private call with advisors. The Treasury Secretary issued a statement calling Berkshire's move isolated portfolio rebalancing that does not reflect the fundamental strength of U.S. government securities. But the market is not listening to the Treasury Secretary. The market is listening to the man who built $400 billion from a textile company in Omaha. The administration faces an impossible dilemma. If they attack Buffett publicly, they validate the narrative that the government is at war with its own creditors. If they ignore him, the bond sell-off continues and spreads. If they try to intervene through the Fed, they confirm the fiscal dominance thesis that the government can no longer fund itself through market mechanisms. Every door leads to a room that is on fire. Let us talk about what this means for the average American watching this, the person with a 401k, a pension, a savings account. Here is the brutal truth. If you own a target date retirement fund, you own Treasury bonds. If you own a balanced mutual fund, you own Treasury bonds. If your pension fund is invested according to standard actuarial guidelines, it owns hundreds of billions in Treasury bonds. When those bonds lose value because yields are rising and bond prices move inversely to yields, the reported value of your retirement account drops. This is not a paper loss. This is the purchasing power of your future evaporating in real time. Retirees who depend on bond income are watching their monthly distributions shrink because the market value of their holdings is collapsing. New bond purchases offer higher yields, yes, but the existing portfolio is hemorrhaging. This is the cruelest irony of the Buffett bomb. The asset that was supposed to protect you in retirement is the one that is destroying your security. History teaches us that when the most cautious investor in the world runs for the exits, it is not a drill. In 1999, Buffett refused to buy tech stocks while every amateur trader in America was getting rich on dot-com garbage. He was mocked as a dinosaur. Within 18 months, the Nasdaq had lost 78% of its value. In 2005, Buffett began warning about derivatives as financial weapons of mass destruction. He was ignored. 3 years later, the subprime crisis destroyed $10 trillion in household wealth. In 2020, he liquidated airline stocks at the onset of COVID, crystallizing losses that other investors held through years of recovery. He was criticized. But the airline industry received $54 billion in government bailouts because it was functionally insolvent. Every single time Buffett has made a dramatic, counterintuitive move, the market has eventually validated his thesis. Every single time. The question is not whether Buffett is right. The question is how much time you have before the rest of the world realizes he is right. This is not just about money. This is about the American covenant. The founders understood that a nation's credit is its lifeline. Alexander Hamilton built the entire financial architecture of the United States on the principle that the government would always honor its debts. The full faith and credit clause was not a slogan. It was a sacred promise. When Buffett says the covenant is broken, he is reaching back 234 years to Hamilton's original bargain and declaring it void. He is saying that the accumulated recklessness of decades, the $38 trillion in debt, the $1.14 trillion in annual interest, the political inability to either cut spending or raise revenue, has finally exceeded the tolerance of the market. The emoluments of fiscal irresponsibility have come due. And the bill is being presented not by a foreign adversary, not by a political opponent, but by a 95-year-old man in Omaha who simply looked at the numbers and decided he could no longer pretend. We are in uncharted waters. The maps are useless. No model accounts for the world's most trusted investor publicly declaring that U.S. government debt is no longer trustworthy. The algorithms that run 70% of daily trading volume are processing a signal they have never seen. The risk models that govern $200 trillion in global derivatives are being stress tested against a scenario they were never programmed to handle. The rating agencies, who still maintain a sovereign credit rating of AA+ for the United States, are reportedly convening emergency reviews. If Moody's or S&P downgrades the U.S. again, the forced selling from pension funds and central banks that are mandated to hold only top-rated sovereign debt would trigger a cascade that dwarfs anything we have seen since 2008. As we head into the weekend, watch the gold market, watch the Swiss franc, watch the Japanese government bond yields when Tokyo opens Sunday night. Watch for announcements from Vanguard, BlackRock, and State Street about changes to their Treasury allocation models. Watch for emergency statements from the Federal Reserve. But most importantly, watch the 10-year yield. If it holds above 5% through Monday's close, the repricing of American sovereign risk becomes permanent. The world's largest debtor nation will be paying a risk premium for the first time in modern history, and every mortgage, every car loan, every student loan, every credit card in America will carry that premium on the backs of ordinary people who never asked for this. Warren Buffett did not start this fire. The fire has been burning for decades, fed by bipartisan fiscal negligence and a political class that treated the national debt as someone else's problem. What Buffett did was point at the flames and say the house is burning, and now everyone can see the smoke. The covenant is broken, the oracle has spoken, and the bond market, the $31 trillion engine that funds the American government and underwrites the global financial system, will never be the same. Subscribe, stay close, because when the man who never panics starts running, you do not walk, you run. The history books are being rewritten this weekend and your retirement account is caught in the pages. Let us get technical about one more mechanism that nobody in the financial media is discussing because it is the hidden detonator in this crisis. It is called the basis trade, and it is the reason why the Federal Reserve is terrified tonight. Hedge funds, particularly the large systematic funds like Citadel and Millennium, have built enormous leveraged positions that exploit tiny price differences between Treasury futures and the underlying cash bonds. The total notional value of the basis trade is estimated at $800 billion to $1 trillion. These positions are leveraged 50 to 100 times. When Treasury prices drop suddenly, as they did today, the margin calls on these leveraged positions are instantaneous and brutal. The funds must either post more collateral or unwind the trade. Unwinding means selling cash treasuries, which pushes yields higher, which triggers more margin calls, which forces more selling. This is the self-reinforcing death spiral that nearly broke the Treasury market in March 2020. The difference is that in 2020, the Fed was already buying $120 billion a month in Treasuries and could ramp up quickly. Today, the Fed has been doing the opposite, running quantitative tightening, and has $7.4 trillion on its balance sheet that it has been trying to reduce. Reversing course now would be an admission that the government bond market cannot function without central bank life support. That admission, in the wake of Buffett's exit, would be the final confirmation that the covenant is indeed broken. The oracle saw this. He always does. And this time, he decided not to ride it out. He decided to leave. That is the signal. That is the warning. And that is why, for the first time in your lifetime, the safest investment in the world might be the most dangerous one you own.